Look, it's definitely not pleasant to go through a market correction. It wasn't fun last year and it definitely wasn't fun this year. But it's also really easy to get caught up with a short-term view. So in this video, I want to share with you the damage the market correction has done to my portfolio so far. And I want to diagnose one of the areas where I got complacent on during this period. It's important to me to share all my ups and downs, document my mistakes so that I don't make the same mistake in the future. Also, I did mention I'm going to go through Appen's earnings, so I'll share my insights on that towards the end of this video. Alright, let me get the boring stuff out of the way. No, because I didn't fulfill my Asian prophecy, I'm not a professional, and this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes to lighten up your day. Firstly, I want to go over why bond yields are going up, why that's not a bad thing, and why the Australian market seems to follow the US market very closely. Now, bond yields go up because bondholders are seeing more attractive investment options besides bonds. And in order to rotate money out of bonds into something like equities or commodities, they do have to sell down their bonds position. The question is, why are they rotating money out of bonds? Well, there's a belief that because the vaccine is here, people start going out more, they'll spend more money, and beating up industries like financials, travel, and retail will start to perform better from here. On top of that, with a massive stimulus bill on the way, more money is chasing after the same goods and services, driving up the cost of commodities like oil, natural gas, and metals. And all of that improves the prospects of mining and industrial companies. So it definitely doesn't surprise me that investors are positioning themselves to be prepared for inflation and the broader economy recovering. From that perspective, yields going up is actually a sign of the broader economy recovering. That's definitely not a bad thing. On top of that, money rotating into traditional value stocks give high-flying growth stocks a bit of room to breathe. And that gives long-term investors like me a chance to purchase some of these stocks without having to overpay for things. Now, I know that a few of you are wondering whether the correction is over. The truth is, the Nasdaq is only down about 6%, S&P is only down about 3%, you can barely call that a correction. So personally, I'm not an oracle, but I don't personally believe this is over. And this is one of the main reasons why I picked up extra client work to boost my income so that I can invest more during this period. Now, on the point of why the Australian market seems to follow the US market very closely, one of the simplest ways to understand this is to look at the foreign ownership, especially the US ownership of our top 20 biggest ASX companies. The graph you see is produced by Professor Fernandez from UNSW using Bloomberg company ownership data. The data might be a little bit outdated, but you get the point. The darkish blue bars are percentage of US ownership in our top 20 biggest ASX company, and the yellow bars are percentage of Australian ownership. So there seems to be quite a big foreign ownership in some of our biggest companies on the ASX. And since the top 20 companies make up basically half of the market cap of ASX, I can understand why the market will move pretty closely with the US market. I want to show you one more thing before I move on to talk about my portfolio. In this study by BCG and Morgan Stanley, where they looked at the key driver of long-term stock performance between 1990 and 2009, top-line revenue growth turns out to be the key drivers. So while I understand that I need to be aware of the macro environment, I'm going to continue following my own strategy, earn more income, invest in great companies at a reasonable price. And this is a really good point for me to transition to my portfolio, because at a reasonable price is where I got complacent with one of my positions. So let's talk about it. Now let me give you a quick summary. Since my last portfolio update, I actually added another $3,500 into my portfolio. So at the time, it was worth 136,000 Australian dollars. But now it's worth about 129,000. So comparing those two periods, I'm down about 5%, a little bit more than 5%. Overall, I'm still up, but let me take you through the individual components of my portfolio. Again, I just want to remind you that this is not financial advice or recommendation for you to do anything. It's just my own reasoning for going down a particular path. Now, with my CMC market portfolio side of things, it's currently worth about 81,000 Australian dollars. And as you can tell, Asia did go down for me, and so did two of my US SPACs. Now, my conviction is very high for both of them, so I'm really not too fussed. And I'm also not too fussed that Asia is going down as well. In the coming weeks, I will be investing more into my portfolio, so I'll keep you posted in terms of how I allocate my capital. For my stake portfolio, it's currently worth about 37,000 US dollars, which is give or take approximately 47,000 Australian dollars. And over the week, as HIM's Porch, and also Disney went down, I actually added more into HIMS, I added more into Porch, and I added more into Disney. Everything else is staying exactly the same. So I have to admit, I got complacent on HIMS valuation, but let's talk about it. In my 3 steps I took to survive the next market correction video, I mentioned all of the qualitative reasons on why I like HIMS as a company over the next 5 years. And if I had to summarize, HIMS had great unit economics, greater than 40% revenue growth over the next 2 years, expanding gross margins, big and growing total addressable market, and is still a co-founder-led company. Not to mention, I do have experience in the telehealth industry and mentioned that's one of the industries I'm really interested in over the next 5 years as well. So after all of that due diligence, I generally like to look at some simple comparables table, look at the expected return at a given revenue growth rate, and look at the charts as well, just to keep myself accountable. I'm not going to show the expected returns table because that's really dependent on your own beliefs. But here's a comps table I used to look at the valuation for HIMS. Now, Teladoc and GoodRx are some of the main competitors for HIMS, and they're both in the telehealth industry, except their focus is more on primary care and general medical conditions like cold and flu. GoodRx also helps aggregate pharmacy prices for prescription medicine, so there's an element of helping consumers save as well. Now, the first time when I looked at this comps table, GoodRx was trading at $54 with a 20 billion enterprise value, and they also had a 38% compounded annual growth rate for their revenue with a 94% gross margin, which is like sky high, by the way. But their trading multiple, especially for their 2021 estimated revenue, was 38 times, and that's like significantly higher than the rest of these companies in this comps table here. So that was just a little bit too expensive for my liking. And then when I looked at T-Doc, they were trading at $283 at the time with a 40 billion enterprise value. So this is really not a small cap anymore. This is mid cap, at least in my opinion. And they had an estimated compounded annual growth rate for their revenue at 68%. And this is after their merger with Livongo. And even at a gross margin of 66%, they were making $2 billion in revenue. So imagine growing $2 billion at 68% compounded annually over the next 3 years. That's massive, even though HIMS gross margins is better than T-Doc. That was error number 1. So when I looked at HIMS, they had an enterprise value of about 3.8 billion. Their EV revenue was a little bit higher, but their gross margin was much better, but they had a lower compounded annual growth rate. On top of that, HIMS already expanded on their EV revenue multiple by 2 times. It went from 10x to about 20x ever since they debuted on the public markets. So I should have known better. Hindsight is 2020, but I want to show you the charts as well. And at the time when I was monitoring HIMS, they were trading at an all-time high at $25, and that was just way too expensive for my own liking. But over the next couple of days and week, it actually corrected about 18-19% to about $21. And that's when I thought that would be a good time for me to start building my first position. But because of my own confidence in my investment thesis, and not to mention my experience in the industry, I started with a bigger than usual position. And that's error number 2 because I got overconfident with my own experience. And error number 3 is that I should have paid more attention to the macro environment. And I don't mean obsess over it, I just mean being aware of it. And I think that looking back, if I was a little bit more aware, then I would have been a little bit more cautious as I was building this position. So I wanted to take this opportunity to document my own learnings, and because of my complacency in valuation, overconfidence in my thesis, and lack of awareness of the macro environment, I think those are some of the major contributors on why my purchasing price for HIMS is so high. Long story short, yeah, I messed up. Over a long time horizon, I don't believe that anyone has done a better job than removing the stigma around sensitive men's health topics, and that's why I added more into HIMS as it went down. Okay, let's talk about Appen. Now, as of recording this video, Appen has been trading down since August 2020, now at about $16.96 with a 2 billion market cap. Now, before we talk about financials, Appen collect, annotate, and sell massive datasets to anyone who want to build and refine their machine learning algorithm. And these datasets are collected and annotated by humans across the internet. Yes, they are also growing their machine-powered annotation capabilities. Not to mention, they also have a platform where developers can automate low confidence labeling for humans to review. Now, a lot of good things happen despite a very rough year. Appen has won 136 new customers in 2020, 34% increase in projects with existing customers,
and China revenue is growing pretty quickly with a very small customer base. Not to mention, their annual contract value have grown quite substantially in 2021, at least so far. Their balance sheet is strong with $78 million worth of cash, and there are plenty of current assets to cover the current liabilities. Not to mention, they have grown their cash flow by about 38% compared to the previous year. But despite revenue growth of 12%, underlying EBITDA by 8%, they were impacted by the pandemic as some of their customers reprioritized spending. And as crazy as it sounds, the rising Australian dollars have also caused problems for them because some of the bigger customers do pay them in US dollars. So the earnings result, in my opinion, was pretty good, but it seems like the expectation is just so much higher. And they still provided guidance for 2021, with EBITDA growing at about 17 to 27%. But the near-term headwind of the rising Australian dollar and the uncertainty around the first half of 2021 earnings being pushed to the second half of the year is, in my opinion, what contributed to the massive sell-off right after the earnings result. Now at this point, Appen is trading at 3.3 times their last 12-month revenue and about 28 times their last 12-month EBITDA, which is substantially below its historical average. And if you were to compare companies like Xero and WiseTech against Appen, Xero and WiseTech are trading at significantly higher multiples, somewhat justified by a much higher growth rate. So the question for you is, what do you believe is the future prospect for Appen? Because depending on what you believe, that will determine whether Appen is a value trap or it's undervalued.
Personally, one of the main reasons why I never considered Appen to be part of my portfolio is because I just don't like the business model. Using people all over the internet to collect and annotate data and then sell those data sets to people who want to tune their machine learning algorithms just really isn't that appealing to me. And plus, it doesn't align with my own process where I'm looking for companies who can grow their revenues at 30% and above at a reasonable price. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.